This is Chapter 5, Video 2. Let's launch. So learning objectives for this video, we're going to discuss the distinctions between various sources of income, including income from services and property. And so types of income, we have income from services, earned income. For example, you go work for somebody, they pay you cash. That's going to be income. That's a pretty easy source of it. Income from property, which is going to be unearned income. There's going to be gains and sales from the gains and losses from the sale of property, dividends, interest, royalties, and annuities. Depends on type of income and type of transaction generating the income as to where it goes on the tax return. And we'll talk about that here later on. With annuities, an investment that pays a stream of equal payments over time. Most of the time, clients are going to get involved in this as part of retirement planning. They want to get a fixed set of income going forward. So say, for example, they save up, a couple $1 million for retirement, and they say, I want to receive this income over 30 years. They sell the $2 million to the annuity company. They get fixed income going forward, which usually will include a return of their $2 million plus interest earned over that time. So a portion of the annuity payment is non-taxable return of capital, and the remainder is gross income. And the way that you're going to see that is if you take a look at a 1099-R, you'll see that there's going to be a box 1, which is going to be taxable income, gross distributions. Box 2 will be the taxable amount, which should be the difference between box 1 and box 5. Box 5, which is going to be the return of capital. Those two subtracted should get you your taxable amount with any of that. Generally, they're going to say, original investment versus expected revenue value. As a tax preparer, though, you're probably going to end up dealing with most of that on your own. And you're going to figure that out by yourself. Sometimes the companies are really good about doing that for you. Sometimes you have to figure it out on your own. I tend to notice this a lot with OPM payments. Sometimes they won't put in a taxable amount. They'll kind of have you figure it out. And then usually what I do is box 1 minus box 5 gets me to the taxable amount to be reported. So with annuities with a fixed term, expected values, the number of payments times the payment amount. I'm going to let you kind of look at this. We don't deal with annuities too often in the tax world. And usually when we do, we report what's on 1099-R and then we just kind of move on. Sometimes we have to actually calculate some of this stuff out for them. Very rarely if I had to pull out any table. They say IRS tables are going to do that. That's actually going to be done no more often than not by the annuity company. Now, does that mean that you don't need to know this? No, that's not true. You do need to know this, and you want to make sure that you're keeping up with that. All right, so property dispositions. Usually you realize gain or losses when disposing of an asset. Taxpayers are allowed to recover their investment in property, which is your tax basis, before any realized gain. That's what we talked about in the last video. And, I don't think that I'm going to rehash this any more than I have to. We'll talk about this a lot in detail when we get to Chapter 10 and then Chapter 11. Chapter 11, especially when we're talking about sales proceeds to get you the amount realized, less basis in the property, which is going to be your gain and loss. Other sources of gross income other than wages or business property, very good example, board of director payments. You might also have, some people who say, well, I'm going to go coach some soccer, so maybe they're earning like, $1,000 doing that. They do it as a one-time deal, and as a result of which they have to report it as other income. Used to be on the old tax forms, we used to call those line 21. Of course, that line has changed, and unfortunately, when they changed it in 2018, then they changed it again in 2019. I'm hoping to God they don't change it again in 2020. Although I know a lot of changes will be coming to the tax forms as a result of all the COVID stuff that's happened. Alimony. So for tax purposes, is defined as a transfer of cash made under a written separation agreement. Okay, here's the thing. Under the old tax laws, when I paid alimony to my ex-spouse, which I don't have an ex-spouse, but say I did. When I paid alimony to my ex-spouse, what would happen is that I would get a tax deduction on my tax return, and then the spouse would have to pick it up as income on their return. There's been a lot of abuse in this area, and there's been a lot of audits that the IRS had to do with this. And I actually know one of the people who was very involved in the new tax law reform that took place back in 2017. And when we talked about a lot of the tax changes that ended up happening, one of the biggest factors that he was saying that was on his mind, how much time does the IRS spend auditing this? Because they wanted to reduce auditing costs in order to do that. So there were a lot of things they got rid of. For example, the itemized deduction subject to 2% was one that went away because of that. And then also because of the alimony, they really wanted to get this to where it was no longer deductible by the individual paying it and no longer taxable to the spouse receiving it, because it was just too much audit stuff going on with that. That was causing them a lot of trouble. Payments that do not qualify as alimony, though, is property division. So if you divorce, and as a result of which, say for example, I'll take a husband-wife situation where the husband owned a home, and when they got married, husband and wife cohabitated in the home. Husband did something really stupid, as a result of which the divorce went against him. So he was required to then transfer the house to the wife as part of the compensation. When that happens, it's not alimony. As part of a divorce decree, the way the IRS is going to look at this, they're going to say that's subject to a divorce. A wife doesn't have to pick it up as income, and it wouldn't be that way anyways. Child support payments are also not going to be considered income, because that's going to be compensation to the other spouse who's actually taking care of the kids. And usually it's actually compensation directly to the kids for their support. But it depends on how the divorce decree is written. There's sometimes it can go one way or the other. But generally speaking, those will end once the kid turns 18. And that's how you get this, because what will end up happening, especially if it's a poorly written divorce decree. And when I say poorly written, I'm not talking about the judge. Judge usually does what they ever come to an agreement with. But say, for example, the lawyers didn't do their job, and as a result of which they say, we're going to pay $100,000 a year from husband to wife. But when the kids turn 18, so say there's two kids and say they're twins, when the kids turn 18, they're going to reduce from $100,000 a year to $60,000 a year. What happens is, from the IRS's perspective, is that $40,000, that delta between the $100,000 to the $60,000, is going to be seen as child support payments, and that would not be included in the income under the old rules anyways. Now, some of y'all might say, why do I need to know the old rules anyhow? Because any divorce that took place before, that was consecrated before this tax law change, still follows under the old rules, even though they could be receiving payments for the next 20, 30 years. So you're going to have to know those old rules for a long time coming. Now, under the new rules, none of it's deductible by the spouse paying it, and then the spouse that's picking it up obviously is not going to pick it up as income. So it actually makes it a lot simpler for us in terms of if you have a divorce after December 31st of 2018. But you're going to have to ask the question, and obviously right now it's going to be a big topic. But say 20, I wouldn't say 20 years, but say even 5-6 years from now, more and more of these divorces are going to fall under the new rules as opposed to the old rules. But you're still going to have to ask. Prizes, awards, and gambling winnings. So I had a client. Actually, I'm going to laugh a little bit, because I had a client once who. I remember it was funny. I've been doing his tax returns now, I guess, for about 4 or 5 years. And all of a sudden he got a notice from the IRS saying, knock, knock, knock. You did not pay taxes on your gambling winnings. And the person's like, what do you mean? Do I have to pay taxes on gambling winnings? And I remember him asking me this. He's like, wait a minute, do I really have to pay tax on this? I'm like, yeah, you do. I mean, that's kind of like a normal thing. You got money, and as a result of which it's considered income, ergo you have to pay taxes on it. Now the good news with him is that he had so many losses. Well, and from a tax perspective, this was good news. I don't know if it was good news financially. He had so many losses that we were able to go back and basically say, look, because you have all these different losses, we can go ahead and we can write this off. And so by the time we got everything taken care of, he ended up owing nothing. But again, it was a lot of hoopla for fun, and he had to pay me money in order to fix it. So this is one of the things that sometimes your clients won't be able to pick up. Now, if they fill out their organizer like they're supposed to, they'll actually do that. And of course, that's one reason why we always tell, CPA firms, you got to use your organizers and make sure that your clients are filling them out, or at least getting them, so that you can tell them, hey, look, IRS, I did my due diligence in order to ask them this. They didn't do it. They didn't provide me with that. They didn't mark this answer as correct. Therefore, I didn't know. There's no way for me to know. So it protects you as well as protecting them. There are some exclusions, so scientific or literary or charitable achievements. So, for example, let's just say that I win the Nobel Prize for, determining, a fair tax system. I mean, yeah, hey, I can dream, right? I wouldn't mind, my name is Dr. Kevin Matthews. I'm earning the Nobel Peace Prize, or not Peace Prize, but Nobel Prize for significance in this, because I develop a new tax system that everybody finds to be awesome. Probably never happen. I mean, hey, let me dream for a minute. But basically what ends up happening is that if I get that Nobel Prize, that's not going to be taxable to me because it's a scientific achievement under certain conditions. Employees, length of service, or safety achievement. So if I get up to $400, so for example, I have a staff out here. He works for me for 5 years. I give him a $250 prize. Hey, thank you very much for working hard. Here's $250. Go have a nice dinner with you and your significant other, and he'll be happy. But it's like I said, tangible personal property limit per year for the employee of $400. And then this is actually a recent one, because in the last Olympics back in 2016, this was a big deal, because most countries don't tax their athletes who win because of the service to nation type aspect of it. We didn't have that exemption, and so they went back and they said, "Hey, look, we're gonna exempt a lot of this stuff because the fact is that they're doing things that make our country look great. They're heroes. They're for a whole wide range of reasons. We're going to go ahead and we're going to exclude that income." And so they got that. Social Security benefits. This actually will probably be a question on your CPA exam, how these get tested. You probably want to know this. But Social Security benefits taxable up to 85%. So what happens is, I think, and I'm going to quote the rule. I don't know, can't quote the rules. I'd have to look it up in my quick finder here. But I'm not going to take the time during a video. But I think it's up to $28,000 if you're married filing joint. You don't pay any you don't pay any taxes on your Social Security, and then it's from 28 to 48. You pay tax on 50% of it, and then anything above 48, you're going to pay 85%. And the reason why they're doing this is that, look, if Social Security is all you've got, they're not going to tax you on this. And it used to be in the old days under the old rules. And when I say old days, I'm talking like old days, back before the 80s. Social Security benefits weren't taxable at all. They actually wrote this into the tax law changes that they did. I believe it was in 82 is when they wrote this in, where they said, look, we're going to start taxing some of this. Made some people upset, but obviously not upset enough because, people still got reelected. Again, going back to slide, video one, where, hey, we got to start paying attention to where our politicians are telling us and see if we can get them to make changes. Okay. So, so here it is. Actually, it is single payers. So actually, it's $25,000. If it's under $25,000, not taxable. From 25 to 34, it's 50% taxable. And then when you get to the next part, it's $34,000 above. This is for, I believe, a single person. So I think I was quoting married filing joint rates, and so we'll just go with that. Imputed income, certain types of income discounts, low interest loans. So for example, if I loan money, so I have myself, then I have my company, Beta Solutions. If I loan Beta Solutions $100,000 and I charge it 1% interest, the IRS is going to come back and say, whoa, based on our analysis, that is a below market loan. So what we're going to do is you're going to say, look, you're going to pay yourself that 1% that Beta is actually going to pay you. But we determine based on, and there's tables you can actually look this up on. We determine it based on the tables that we're looking at. You should have been charging it a 4% interest rate. And so that 3% delta, I'm going to actually pick up as income. The bad news is Beta won't get a deduction for it. And that's a bad deal. So it encourages you to do the right things that you're supposed to do in terms of generating those the interest rates correctly. So low interest rate loans, again, imputed using the difference between the amount received versus what the federal rate is. And again, there are tables that you can follow in order to be able to do that. So borrower is deemed to pay the interest. Imputed rules do not apply to aggregate loans of $10,000 or less. So if I just loan them like $5,000 and I go ahead and charge them 1%, no big deal. But if I do more than $10,000, it is a big deal, and I have to do this. Discharge of indebtedness. So, and this actually, I've been actually seeing this a lot lately, which is actually kind of surprising because 2019 was not a bad year. Usually we see this in bad economic times. people will go back to their credit cards and they'll basically say, hey, no money. I can't pay this anymore. And as a result of which, I want you to discharge my debt. Credit cards will do that, but what they're going to do is they're going to send you a 1099-C. 1099-C is going to be a cancellation of debt. And as a result of that, you're going to have to pick that up as income on your tax return. Now, there are certain rules that you can get out of this. For example, insolvent taxpayers, those who do this as a result of a bankruptcy, is another example. And I think there's like a couple others. Most of the time, 90% of the time that I've done this in the past 3 or 4 years, I think in one case I used bankruptcy, and the other cases it was insolvency. And so when you use insolvency, what you do is that you go back to the IRS, or you use that IRS form that they have. And I don't even, actually, now that I think about it, I don't think it's an IRS form, it's a tax software generated form. But they have you list out all of your liabilities at the time, and then you list out all of your assets at the time. And if assets are less than liabilities, boom, you're insolvent and you get to do this. Generally, it only comes up, though, if the taxpayer, if the IRS comes back and says, hey, we're going to audit you. And that's when they're going to come back to this. But my recommendation, anytime that you have a situation where you've got a taxpayer is going to go through insolvency, make them fill out the form on the spot. And here's why. People forget stuff. The typical audit cycle generally is about 18 months. So 18 months later, IRS is going to send you a notice, and then all of a sudden taxpayers are going to be like, I thought this was taken care of. Why are we still dealing with this? And then you have to go back, ask them to fill out the form. They're trying to get old documents, bank accounts that have already been closed. They don't have access to them anymore. So, and then getting access to them, they got to go down to the bank. It's a huge amount of pain and perseverance that they have to do in order to get out of this. And, but if you had them fill out the form immediately as it was, everybody's done. We don't have to worry about it. It's actually a pretty finished thing. All right, so that's all I've got to say about this video on income. I'm very happy to have you guys here, and I look forward to seeing you in the next video.